Hello and welcome. In today's video, we are analyzing Infosys. We are going to look at the company's profile. Then we will move on to analyzing the financial statement, which would include the P&L account, balance sheet, cash flow statement, and quarterly P&L account. And then finally, we will look at the core ratios and compare it with its peer group, as well as look at the technical chart where we can buy or at what levels we can buy into the company. So moving on to the profile of the company, this is a leading company in the IT service space, information technology. It has a large scale operations and a very healthy operating efficiency, a very solid financial risk profile with debt-free balance sheet, and a robust liquidity surplus of 26,403 crores as of December 31st, 2019. The company has steadily increased its share of revenue from digital services. It was 38.3% of revenue in the first 9 months of fiscal 2020 compared with 25.8% in fiscal 2018, which comprises basically of offerings based on artificial intelligence, big data, Internet of Things (IoT), cloud applications, and advanced cybersecurity systems. The company's core services, that is 61.7% of revenue in the first 9 months of fiscal 2020, comprises traditional offerings and primarily include application development and management services, product engineering and management, infrastructure management services, support and integration services. In terms of verticals, Infosys derived about 1/3 of its revenue from the banking, financial services and insurance, which is known as BFSI segment during 2019. The company also has a large presence in other verticals such as retail, which contributed 16% of the revenue in fiscal 2019, communications 13%, energy and utilities 13%, and manufacturing 10%. Infosys' business risk profile is supported by its leading market position, large scale of operations with a skilled resource base of 2,43,454 employees as on December 31st, 2019, proven project execution skills and strong offshore delivery capability. Infosys has a strong financial risk profile driven by its healthy annual cash generating ability and debt-free balance sheet for over a decade. For fiscal 2019, a dividend payout of Rs 13,712 crores was declared. During August 2019, Infosys completed the planned share buyback for 8,260 crore rupees as part of the capital allocation program announced in April 2018. Financial flexibility is strong, supported by robust liquidity in the form of cash and cash equivalent of 26,403 crores as on December 31st, 2019. Despite the acceleration in capital return program, liquidity will remain robust, supported by sufficient funds to finance working capital as well as capital expenditure requirements. Company is exposed to intense competition in the IT industry. The current moderation in discretionary spending by large clients has impacted revenue growth in the IT industry, especially in the traditional outsourcing services. Being a leading player in the IT outsourcing space, Infosys competes with not just Indian IT majors such as Tata Consultancy Services, TCS, HCL Technology Limited, and Wipro, but also global IT giants such as IBM, Accenture, etc. The slowdown in IT spend by global clients and the consequent decline in contract value in the industry has intensified competition among players. Infosys derives around 40% of its revenue from digital services and 60% from traditional IT services. While the company remains exposed to challenging business conditions, its strategy of focusing on the traditional high-volume segments, increasing automation, and building capability in the higher-margin digital and consultancy segments will mitigate the impact on profitability over the medium term. It caters to industry verticals such as financial services, manufacturing, telecommunications, retail, life sciences, media and entertainment, and energy and utilities. The company has entered the business process management services segment through its subsidiary Infosys BPO Limited. As on December 31st, 2019, Infosys had 1,384 active clients and presence in 46 countries. The promoters held 13.15% stake in the company as on 31st December 2019. For the 9 months ended December 31st, 2019, the company reported a profit after tax of 12,304 crore rupees. In the previous fiscal of 2019, the company had reported 11,332 crores and the net revenue of 67,524 crores, and in the previous fiscal it was 61,137 crores. So this concludes my analysis of the company's profile. Let's look at the financial statements. Let's begin our analysis of Infosys Limited by looking at the profit and loss account and looking at the ratios that we can find from the P&L account. So let's begin by looking at the sales growth compounded over 5 years, 3 years, and the latest from 2019. When we look at the recent 12 months of growth in sales, it has increased by 7.73% from 2019. The total sales done in the recent 12 months is 89,063 crore compared to March 19, where the company's sales were 82,675 crores. In March 16, the total sales were 62,000 crores. So this has increased from March 16. And in March 14, the company's total sales were 50,000 crores. That is a 10.52% growth till March 19 in the last 5 years and 9.81% growth in the last 3 years. So company has maintained a growth in its sales over the years. Looking at the average operating profit margin of the last 5 and 3 years, we see a very high OPM margin or top line profit of 26% and more. And if we look in the 2019, 24.4% of OPM against the total sales of 82,675 crores, the company's operating expenses were 62,505 crores. In the recent 12 months also we see a very healthy operating profit margin of about 24%. How much is the other income contributing as a percentage of sales? In the recent 12 months, other income contribution to the total business's profits were 3.2%. 2,854 crores of other income was generated in the recent 12 months compared to the total sales of 89,000 crores. And if you look at the trend of the other income in terms of percentages, March 16 5%, March 19 3.5%, company's overall other income percentage has always been very stable. Depreciation as a percentage of total sales, in the recent 12 months, total company's depreciation, that is the amount charged to the P&L account as depreciation, was 2,676 CR, which works out to around 3% of the total sales of 89,000 crores. If you look at the trend March 16, March 19, the overall company's depreciation percentage was very low at below 3%. And even if you look at the value of the depreciation that was being charged or deducted from the profit and loss account over the years was very stable compared to the sales the company was doing. Company is in a service industry, therefore there is no raw material cost. Employee cost over the years has been very high, and this also gives us very much confidence that the company is paying its employees a good salary, and therefore company would be able to retain the top management team in the business. In March 19, employee cost was 54.82% of the total sales, and it has been reducing its percentage employee cost against the sale over the years. That is, its sales are growing, or its revenue generation is growing faster than what it is paying employees. Interest expense as a percentage of total sales in the recent 12 months was just 124 crores, or just 0.1% of the total sales, a very negligible amount or a very small amount compared to the amount of sales the company was generating. The company is debt free throughout the years. Tax rate as a percentage of total profit before tax in the recent 12 months, 24.8% was paid as tax. 5,412 crores was paid as tax against the total profit earned of 21,795 crores. If you look at the tax structure over the years, the percentage wise it has been very stable and reducing. That is, its profit before tax has been increasing throughout the years, but its tax liability has been decreasing or is very flat. The company is debt free, therefore its interest coverage ratio would be very high and no need to look at the coverage ratio. Net profit margin for the recent 12 months was 18.4%. In March 19, the company had earned 15,404 crore rupees on total sales of 82,675 crores. That's an 18.6% of NPM. In March 16, the NPM was quite high at 21.6%. So the company has managed a high NPM margin throughout the years. Even if we look at the last 5 years, 3 years and the recent NPM margin, it has always been about 20%, except for the recent 12 months where the margin has dropped below 20. In the last 5 years, average was 21%, and in the last 3 years it was 20.8%. Let us look at how the net profit has been growing compounded over the years. In the recent 12 months, the profits or the net profits has grown by 6.1% over its March 2019 values. From 15,404 crores to 16,348 crores. And in the recent 3 years, the profits has grown by 4.5%, whereas in the last 5 years, the profits have grown by 7.6%. When we looked earlier in the sales growth, we did see that in the recent 12 months, the sale had fallen below its March 19 values. That is, the revenue had gone down below the March 19 values, whereas the profits are still continuing to grow in the positive trend. In 14, the total profit earned was 10,656 crores, which increased to 13,489 crores in March 16, and which further went up to 15,404 crores in March 19. So we see an upward trend in the growth in the profits. Looking at the valuation ratio, market cap to sales, here in the recent 12 months, we find that the company's sales were around 89,000 crores against a total market cap of 2,83,000 crores. That is, the market cap was 3.2 times higher than its sales. If we look at the trend of market cap to sales ratio over the years, we see a decreasing trend, which means that at the current market cap to sales ratio, we are getting it at a good valuation. Not only has the market cap come down from March 19 from 3,22,000 crores to 2,83,000 crores, but the sales has gone up from 82,000 crores to 89,000 crores. Generally, if the sales are increasing and if the market cap is decreasing, then we are getting it at a good valuation. But if both the market cap as well as sales is dropping, then that multiple is not justified even if it's low. Dividend payout, that is out of the net profit, how much dividend was given out to the shareholders. In March 19, 60% of the profits earned was given away to the shareholders. The company had earned 15,404 crores. Of that, 9,330 crores was paid off as dividend to the shareholders. And we see an increasing trend in the amount of dividend the company has been giving out to the shareholders. In March 14, company had given up 3,600 crores, which was 33.8% of the total profit. In March 16, 41.1% was paid out. And now in March 19, 60.6% has been given away. So we see an increasing trend of the amount of dividend the company has been paying out. And earlier, when we were looking at the profile of the company, we did look at one of the points where it mentioned that the company has come out with a policy to pay off a huge portion of its holdings in cash and investments to the shareholders as dividend. Let us look at the price earnings ratio, that is the profit that the company earned on each share against that how much price we are paying. In the latest 12 months, the total earnings per share was 38 rupees, for which we paid 17 times more to buy that share based on the earnings. So this is, again, if you look at the trend, this has been falling. So this is a very good multiple that we are getting it at, compared to March 19, where it was available at 20 times its earnings, and in March 16 also around similar multiple. So not only has the price of the company has fallen from 744 to 653 rupees, but the overall earnings per share has increased. So this is a situation that is very good for us to buy into the company, where the price is dropping and profit per share is also increasing at the same time. If we look at the averages of 5 and the 3 years, we see that it was available at around 18.5 times, and in the 3 years 17.4 times, and now the latest price earning is below its averages. Moving on to the balance sheet analysis, the company's equity share capital has been steadily increasing from 286 crores to 1,144 crores in March 16, now to 2,170 crores in March 19. This has been a steady rise in its equity share capital and therefore dilution. This is possible only when the company is giving more bonus to the shareholders, and as the number of shares increases due to bonus, the per share profits decreases. But we see here that the overall company's face value has been very stable at 5 rupees. Return on equity as a percentage of total net worth. Return on equity, that is how much the company earned as net profit on the total net worth or investments of the shareholders, or on the capital of the shareholders. March 19, the company's ROE percentage was 23.7, that is on the total shareholders money of around 64,000 crores, the company earned 15,400 CR. In March 16 and March 14 also it was above 20% on the total net worth. So the company has maintained above 20% of ROE. If we look at the average of last 7, 5 and 3 years, we see that over the years also On an average basis, the company has maintained above 20% of ROE. Return on capital employed looks at how much EBIT the company generated on the total sources of fund the company had. In March 19, on the total source of 64,948 crores, the company earned 21,000 crores in EBIT, which works out to around 32.4%, a very high percentage in terms of generating profits on the total source of funds. March 16 also it was above 30%, and in March 14 it was 33.1%. So throughout the years the company is earning a substantial amount on the total source of funds. Looking at the averages of 7, 5 and 3 years, we see above 30% of ROC throughout the years. Return on total assets measures the amount of net profit the company earned on the total balance sheet size. The total balance sheet size would include your debtors, fixed assets, capital work in progress, your cash holding, investments, and everything that we can consider as assets for the company. In March 19, the total ROA was 18.2%. Of the total balance sheet size of 84,738 crores, the company earned 15,404 crores as net profit. And if you look at the trend of ROA throughout the years, it has always been above 15%. Looking at the debt to equity ratio, we have already seen that this company is a debt-free company, and therefore the debt to equity ratio is 0. Let us look at the equity percentage, that is, how much was the net worth compared to the total assets of the company. In March 19, 77% of the total balance sheet size was through contribution from the shareholders. The company is a debt-free company, and in March 16, the total equity contribution was 82%, a very high percentage. Even in March 14, it was a very high 78%. So throughout the years, the contribution of the shareholders in the total source of funding was above 75%. Valuation ratio price to book looks at what is the market cap of the company and how much was the shareholders' contribution in the business, or what was its net worth or actual book value. Currently, it is available at 4.4 times its book value. The net worth of the company was 64,948 crores. This is the value of the company as per its records. Whereas in the market participants or investors have given it a 4.4 times multiple. That is, it is trading at 2,83,000 crores. That's a premium of 4.4 times. We are getting at a March 16 multiple of 4.4. In March 19, the company's total market cap had increased to 3,22,000 crores against the net worth of 64,948 crores. So what we are doing here in the recent 12 months is taking the net worth of March 19 to compare it against the current market cap. So looking at this multiple, it is quite high because my benchmark is 2.5 and below. That is, I have to buy when the multiple falls below 2.5. But if you look at the trend or where it was in March 19 and also in March 16, we are getting it at a good multiple. The company is a debt-free company, as I mentioned earlier. So this ratio of debt to net profit does not make sense here. Let us look at how much net assets the company had as a percentage of total assets. That is, the components of total assets include your net fixed assets, your investments, capital work in progress, debtors, cash, investments, and so on. So here we are trying to understand of the total component, what was the net block percentage. In March 19, 18.5% of the total balance sheet size was occupied by company's assets or fixed assets, as well as this is tangible as well as intangible assets. In March 19, 15,710 crores of net block was there in the balance sheet. And if you look at the trend of the net block over the years, it has been steadily increasing from 14.6% to 17.8% in March 16 and 18.5% in March 19. The overall value-wise assets have been increasing steadily. This shows that the company is building up its assets over the years. The amount of work in progress to build these future assets is the capital work in progress. Looking at how much of the total assets was occupied by capital work in progress, we see in March 19 only 1.6% or 1,388 crores of work was going on to make new assets or new tangible as well as intangible assets for the company. And we look at a trend, it is quite flat at below 2% of the total assets throughout the years. Investments occupying what percentage of total assets in March 19? It was 13.3%, quite high compared to March 14 and March 16 values. If the company has a lot of cash earnings and it doesn't have capex or capital expenditure requirements, then it can move that money into investing activity and thereby earn other income for the shareholders instead of keeping it idle in the bank. In March 19, 13.3% of the balance sheet was occupied by investing activity. This is not a very substantial amount. It should not cross 30 to 40% of the total assets. 11,261 crores was shifted into investing activity out of the total assets of 84,738 crores. In March 16 and March 14, these were below 10% values. Looking at the debtors percentage, how much payment was still to be collected from its customers in terms of total assets of the company. March 19, 17.5%, that is 14,827 crores was to be collected from its customers out of the total assets of 84,000 crores. In March 16 the value was 15% and in March 14 it was 14.6%. So we see an upward trend in the collection from its customers. This is okay because overall assets of the companies are also increasing, and we see as the company size increases, it has to give more credit to its customers. In this chart, we are looking at the debtors as a percentage of total sales. That is, in March 19, the total sales were 82,675 crores. Of that, 14,827 crores was shown as debtors or payment to be collected from customers, which is an 18%. And if you look at the trend, it is quite flat at 17% in March 14, March 16, 18%. So the company has managed to keep its debtors as at a fixed percentage of its sales. So it is very efficient in the sense of collecting payment from its customers against the sales it is doing throughout the years. Debtor days measures how many days the company is taking to collect payment from its customers. In March 19, within 65 days it was collecting this pending amount from its customers. In March 16, the value was 66 days and in March 14, 61 days. So over the period, we see that the company is efficiently collecting its outstanding payment from its customers. Cash holding as a percentage of total assets. Here in March 19, 23% of the total assets was in cash, which is a big percentage considering that in March 16 it was 43% and in March 14 45%. A major chunk of the total assets was occupied by cash holding. I don't want to see a very huge portion of cash or liquid holding in the company. Rather, this has to be shifted to the investing activity to earn other income for the business, or if not, then pay off as dividend to the shareholders or do buyback or acquire other businesses for growth purpose. In March 19, the company has brought down its cash holding from 32,697 crores to 19,568 crores, which is almost 50% fall from March 16. This is a good value because overall the company has managed to reduce its cash holding. Now, this could be because the company may be giving out a high dividend to the shareholders and doing buyback as well as bonus, and thereby reducing its cash holding. Current ratio measures how much is the current liability or those liabilities which it has to pay or clear within 1 year. Against that, does it have assets to do that? Throughout the years, we see the company was always in a comfortable position of above 2.5 times of its current liabilities. In March 19, the total liabilities were 19,790 crores. These are the liabilities which may arise or which will arise within 1 year, for which the company needs assets or money to sell off and pay. So company's assets are 56,379 crores, which is 2.8 times higher than what it has to pay in the current year of March 19. So the company's liquidity position or current ratio is quite good. Moving on to the cash flow statement analysis, this is a very important statement that all investors should definitely look at. Let's compare the net profit with the cash flow from operating activity. Cash flow from operating activity includes only cash coming in and going out of the business's operating activity, and that too only in cash. So all non-cash incomes and expenditure are excluded from this calculation, whereas net profit includes both cash as well as non-cash incomes and expenditure to come to the final net profit value. Therefore, there is a very high chance that the net profit may be manipulated or changed to suit the company's overall position, whereas cash flow shows only cash position, that is how much cash went out or came into the business through the operating activity. So we have three activities: operating activity, investing activity, and financing activity. So first, let us compare. If the company has shown a net profit, then is it receiving that profit in terms of cash? March 19, the company's cash had a shortfall of 4% against its net profit. So company had shown 15,000 crores of net profit and the cash coming in was 14,841 crores. Generally, I would like to see the overall cash flow from operating activity to be more than the net profit. March 16, the shortfall was by around 10,000 crores against the net profit of 13,489 crores. In March 14, the shortfall was around 8%. Let's look at the long-term trend of 3 years, 5 years and 7 years in the net profit to cash flow from operations ratio. So when we are looking at the long-term chart, it will give us a very good picture as to how much net profit the company is earning over the years and how much cash it's receiving. In last 3 years, the cash shortfall was around 14%. So out of the 45,000 crores of net profit that the company declared, the company received 39,500 crores of cash through the operating activity. In last 5 years, the shortfall was little higher at 19%, and in the last 7 years, the shortfall was around 18%. So although the company is showing profits, the cash inflows are little less than the profit. I generally want to buy into companies who have cash from operations near to their net profits or above it. Next, we'll look at how much cash the company earned, and of that cash, how much was put into investing activity over the years. In March 19, the company had earned 14,800 crores of cash from operating activity. Of that, the company's outflow into investing activity was 632 crores. That's 4% of the cash earned, which is a very small percentage. And in March 16, it was 9% of the total cash put into investing activity. In March 14, 26% of that cash was put into investing activity. So we see a gradual downward trend in the amount put into investing activity. Now the cash from investing activity includes all investments done in purchase of fixed assets or assets, and also in terms of investing in mutual funds or shares of other companies. So this is a good percentage. That means that the company is not putting a lot of cash earned from operations into investing activity, and therefore a major chunk would be left free to be used in the financing option. The financing option, as I mentioned earlier, that the cash flow statement was divided into three parts: cash from operations, cash from investing activity, and cash from financing activity or in financing activity. So basically financing activity includes your bonus, buyback, loan repayment, and so on. And investing activity includes the investments in fixed assets or purchase of mutual funds and so on. And operating activity includes all expenses done in cash and all incomes received in cash only from the operations of the business. When we look at the long-term trend of 3 years, 5 years, and 7 years, we see a stable percentage of investments done from the cash earned. So in the last 3 years, 27% of the cash earned was put into investing activity. Similar situation was there in the last 5 years. 18% of the total cash earned was put into investing activity. The values were very close by, although the cash earned in those 5 years was very high. Finally, let's recap the valuation ratios to understand whether we can buy based on these valuation ratios. Price to earning was 17 times, price to cash 19.1 times, both below my benchmark of 25. Price to book a bit high at 4.4. I want to buy when it falls below 2.5. Market cap to sales at 3.4. This is reasonable. Anything above 6 is a high value. So only in terms of price to book it is expensive, but we have to look at the trend and also look at the peer group comparison where other group companies are trading in terms of price to book, and then we can make a decision as to whether we should wait or we can start buying into the company. Let's move on to the quarterly profit and loss account analysis. Sales YOY and quarter on quarter growth rate was in positive. From December 18 to December 19, the sales saw a 7.9% of growth, whereas from September quarter to December, a jump of around 2%, that is from 22,000 crores to 23,000 crores. In terms of profit, YOY as well as quarter on quarter, both were in positive. From December 18 to 19, YOY 23.5% growth in its profits, from 3,600 to 4,400. Whereas quarter on quarter also there was a positive growth in profits of 10.9%. So this is a very positive sign where we want both YOY and quarter on quarter sales as well as profits to be in positive. Net profit margin on a quarterly basis has always been above 15% throughout. In December 18, NPM margin was 16.9, and in December 19, the NPM margin was 19.3. So overall, the company is in an upward trend in terms of net profit over the 3-quarter data that we have. And this concludes my analysis of the financial statements of Infosys Limited. Next, we'll move on and compare Infosys with its peer group companies and look at core ratios, and from there on to the technical chart, and if possible I'll include intrinsic value calculation, that is at what price is the entry justified. In terms of technical chart, I use RSI to start my buying, but based on fundamental also we can use a system whereby based on fundamental data that we have or a projection that we have, we can start buying from a certain price point. Let's look at the overall peer group comparison of Infosys with TCS and HCL Technologies. Here in this comparison, I'll be focusing on Infosys more than the other two companies. So let's begin by looking at the current market price. Infosys is currently trading at 652 rupees, TCS is available at 1800 and HCL at 430 rupees. The results for all three companies are up to date till December 2019. Comparing the sales YOY, Infosys has managed to grow its sales from 21,000 crores to 23,000 crores from December 2018 to December 2019. Infosys also has increased its overall sales or revenue from 37,000 to 39,000 crores. HCL Technologies sales has also gone up from 15,000 crores to 18,000 crores. So all of these companies have shown higher revenue compared to its previous year's quarter. So the highest sales growth was seen for HCL Technologies at 15.5%, followed by Infosys at 7.9% and TCS at 6.7%. Moving on to the net profit growth rate over its previous year's quarter, that is YOY, the highest growth in profits was for Infosys at 23% from 3,600 to 4,400 crores. TCS managed to grow its profit at a very small growth from its previous year's quarter, whereas HCL Technology saw a 13% of growth in its profits from its previous year's quarter. In terms of sales in the recent 12 months and where it is compared to the 2019 value, in the recent 12 months, the Infosys had total sales of 89,000 crores against 2019's sales value of 82,000 crores. So there's a growth in sales over the entire 1 year period. TCS has seen a growth from 1,46,000 crores to 1,55,000 crores, whereas HCL Technologies sales has grown from 60,000 crores to 68,000. So all three companies have grown their revenue over 2019. In terms of profit after tax, Infosys had earned 15,000 crores in 2019 against the recent 12 months profit of 16,300. Here also we see growth in the profits. Similar is the case for TCS as well as for HCL. All three companies have shown positive sales as well as positive profit growth rate over the 2019 period. Next, we'll look at the profit after tax of 2019 and compare that with how much cash was received through operating activity in 2019 itself. Infosys had shown 15,000 as profit after tax, against which its cash inflows were around 14,800 crores. So a shortfall in cash against the profit. Similar is the case with TCS, where the cash inflows through operating activity had a shortfall against the profit declared. HCL Technologies also had a shortfall in its cash against the profit. So all three companies' cash inflows are little lower or less than the profit declared for 2019. Let us see how much each company has fallen from their respective 52 weeks highest price point. The highest fall was seen for HCL Technologies at 30%, followed by Infosys at 22% and TCS at 20%. Looking at the price to earnings ratio, we see that HCL Technologies is available at the lowest price to earnings multiple of 11 times, followed by Infosys at 17 and TCS at 21 times. If you look at Infosys average, it stood at somewhere around 16 and 18 times for both 3 years and 5 years average, whereas currently it is available at 17 times. So it is very near to its averages. TCS is also very near to the averages. HCL Tech is trading at a discount to its average. In terms of price to operating cash flow comparison, here Infosys is available at 18.7 times, whereas TCS is available at 23 times and HCL Technologies at 13 times. So all these three companies are below my benchmark of 25. In terms of average also they are below 25, and in fact the current price earning is below its averages also. The price to book value for Infosys is 4.5. When we were analyzing the graph, I mentioned that we have to look at Infosys price to book with its peer group comparison and see where it is trading. So compared to TCS, which is available at 7.2 times its net worth, it is expensive. HCL is available at 2.56 times, nearing my benchmark. So Infosys compared to TCS is trading at a discount, but compared to HCL Technologies is higher than that. Let us look at the price earning and profit growth rate of 5-year comparison and see if this price earning of 17 is justified. So whenever the PEG ratio is below 1.5, that is the good time for price earning multiple to be bought into. So PEG for 5 years is 2.2 and PEG for 3 years is 4. What this basically means is that for a price earning of 17 times that we paid for the earnings, that earning itself in terms of profit growth is growing at 7.4% and 4.2% since last 5 years and since last 3 years. So therefore, although we are paying 17 times, the earnings growth for which we are paying 17 times is growing at just 7.45% and 4.2%. So we have to either wait for the price earning to fall or we have to wait for the profits to grow at a faster pace in the 5 and the 3 year period so that the PEG comes down to 1.5. PEG is calculated by dividing price earning with the profit growth projection of the last 5 years and the profit growth rate in the last 3 years. TCS PEG is 2 and 2.2. So this is better than Infosys PEG. Compared to that, HCL Technologies is available at the best valuation in terms of price earning of 13, and not only are we getting it at a low price earning, but the profits are also growing at above 20% for both 5 and 3 years period. Moving on to the sales growth of last 5 years, all the three companies have managed to grow their sales or revenue generation over both 5 and 3 years period at above 10%. The highest growth in revenue was seen for HCL Technologies at 18 and 24%. Let us look at the return on equity percentage and compare that with its averages. Infosys, when we compare it for 2019 values, has earned around 23% on shareholders' money, whereas TCS and HCL Technologies have earned above 25%. Maximum return was given by TCS. Even if we look at its averages of both 5 and 3 years, it's very high, above 30%. Infosys is returning around about 20% of ROE for both 5 and 3 years. Similar is the situation for HCL Technologies, above 25% of ROE. So all these three companies are very efficient in terms of profitability. Return on capital employed of 2019 for Infosys was 32%, TCS 47%, and HCL Technologies 30%. A very high profitability ratio for TCS. Even its averages of last 5 years and 3 years were very high. Comparing that with Infosys and HCL Technologies, above 30% of generating capability for both Infosys and HCL Technologies. Are very good numbers for all the three companies. Return on assets of the recent 12 months were 23% for Infosys and HCL Technologies, whereas TCS generated 35%, and that is why we see a high price to book valuation for TCS, because its profitability generation capacity is very high. Asset turnover for all the companies is very similar, less than 2 times. So its revenue generation is approximately around 1.27 times higher than its assets for Infosys. For TCS, it is 1.64 times. All the three companies generally won't have inventory holding, as these are service oriented companies. But in terms of TCS, it's showing around 8,100 crores of inventory, or the goods on which the work was progressing in 2019 at 8,100 crores. 3 years back, the amount of work in terms of inventory holding was 6,300 crores. HCL Technology has a very small inventory holding percentage. Let us look at the 5 years profit after tax and cash flow from operations, and then compare that with the amount of free cash flow holding that the company has. Infosys had 71,000 crores declared as profit after tax over the period of last 5 years. TCS profits were 1,26,000 and HCL had 40,000 crores of profit declared over 5 years. In terms of cash coming in through operating activity, Infosys had shown 57,000 CR of cash, whereas TCS had shown 1,17,000 crores. HCL Technologies had shown 36,000 crores. So if you look at percentage wise, Infosys cash inflows has fallen short of the profit declared, whereas TCS is very nearby to its profit after tax value. One thing we need to keep in mind is that when we are analyzing these peer group comparison, screener.in, from where I've sourced these data, has excluded from profit after tax all exceptional gains and losses as well as extraordinary gains and losses. So we have a higher value of Infosys in terms of profit after tax, against which the company had earned 57,000 crores. Out of this 57,000 crores of cash earned through operations, 45,000 crores was left free to be distributed in the financing activity. TCS had a very high free cash flows of 1,06,000 over a period of 5 years. HCL Technologies' free cash flow holdings were around 22,000 crores. So all these companies have been generating a high cash flow, and not much of that has been invested back into asset or acquisition. Infosys' average profit of the last 5 years was at around 14,000 crores, whereas TCS was at 25,000. HCL Technologies' profit over an average period of 5 years was less at around 7,800 crores. So we can see the size of the company from the average profit that these companies are earning. In terms of market cap to net worth, Infosys market cap was 2,77,000 crores. This is the value of the company in the market. If we compare the TCS market cap, it is almost 3 times larger than Infosys. HCL Technologies market cap is around 1,16,000 crores. So all of these three companies are high market cap companies of above 1 lakh crores. Net worth of Infosys was 60,000 crores, TCS at 95,000 crores, and HCL Technologies at 45,000 crores. All of these companies would have a negligible contingent liability against its net worth. Again, all these three companies are almost debt free. HCL Technologies having highest debt to equity ratio in terms of peer group comparison. All three companies would also have a very high interest coverage because they would not have any interest payout or finance cost because of their debt free status. Promoter holding for Infosys is low at 13.15% compared to TCS at 72% and HCL Technologies at 59%. This gives us confidence that TCS and HCL Technologies promoters have a high stake in the business and would do everything needed to keep the profits inflows intact. None of the promoters of any of these companies have pledged their shares except for Infosys at 2.94%, which is a negligible amount. Next, we'll look at the debtors to sales percentage. Infosys total payment to be collected from its customers at the end of 2019 against the sales was just 20%. HCL Technologies debtors also had to pay around 20% against 2019 sales. And TCS was at a debtors to sales of 17.8%. In terms of pending collection from the customers, Infosys, TCS and HCL Technologies all are taking less than 70 days to collect from their customers. My benchmark here is 90 days. Finally, looking at the net profit margin and the dividend yield, Infosys margin stood at 18%, TCS highest at 21.4% and HCL Technologies at 16.75%. This is the 2019's net profit margin values. Infosys at current price is giving a dividend yield of 3.3%, highest in the group, compared to TCS at 1.64%. This concludes my analysis of peer group comparison of Infosys with TCS and HCL Technologies. Let's move on and look at the graph of the price and look at where the RSI is and see where we can buy using resistance and support lines. So let's move on to analyzing the graph or the chart of Infosys. I have a weekly chart and I use relative strength index to start my entry or my buying from whenever it reaches below line 30. That is the time when the stock is oversold. Now I don't use RSI for every script. I use it only for fundamentally strong scripts because my technique is that I have to buy as the price goes down. So in that it becomes very risky if the fundamentals of the company is not there. If it's not a strong fundamental company, then the price may keep going down unlimited and we don't have, or I don't have the capacity to keep buying at every low. So I have to use a system where I can start at a certain price point and then buy on certain resistance and support lines, up as well as down. So today is 29th March 2020, Sunday, and the last graph or the last candle that we had was of 27th March 2020, Friday. A week before that, on 20th March, the RSI had fallen below 30. Now this was the time to start buying. I am delayed in making this video by 1 week and the price has moved up to 652 rupees. I have bought from 600, 620, 645. These three we are supposed to buy. Even if the price comes down below in the weeks going ahead, then we can buy 645, 620, 600, and if the price still falls below, then we can buy at 555. These are the levels that we can buy into the script. So 555, 515, 475 if it does come there. Then I also have levels of 445, 370, provided it comes down to these levels, and going up I have level of 700 and 750. I generally would not recommend anyone buying at these high levels because the fundamentals of this company is not that great that it demands us that we buy at the very top also. So these levels from 645, 620, 600, 555, 515, 475, 445 and 370, these are all good levels that we can enter. If we notice, in November 2016 the RSI had gone below 30 level. At this time I had bought into this company, and from there it had given me a 50% gain over a period of 1 or 1.5 years. Now again we can buy these levels and also buy the down levels that we have on the chart. So this analysis that I'm doing of Infosys on a technical basis is to understand where I can start my buying the RSI gives me a indication of oversold levels, but that may not be true as the price may still keep going down. So then I have to use support and resistance lines to put my money in a staggered manner down as well as up. So this concludes my analysis of the technical chart. In this video, I am also using fundamental intrinsic value, what I call intrinsic value in my sense of projecting where the price should be compared to the profit growth, the sales growth, the equity growth, the return on equity growth rate, and the cash flow from operations growth rate from 10 years back, 5 years back, 3 years back. So we can use different kind of techniques to come to our own intrinsic value. As far as technical is concerned, we were supposed to buy using RSI from 585 onwards going down, but right now the price has moved up to 652. So we have to wait patiently for the price to move down to 645, 620, 600 and so on. Let us look at the intrinsic value of the company based on fundamentals. In this part of the video, I am looking at the intrinsic value. I have my own proprietary intrinsic value calculation. What I do is I project the growth in profits, growth in sales, growth in the total balance sheet size, and growth in the cash flow from operations over the period of 5 years and 3 years, and average it out to get my 4 different intrinsic values. So the values that I have is 868 rupees, 798, 706 and 646. If I average all of these 4, I get a single average intrinsic value of 754 rupees. The current price is 652 rupees, and from the current price to the average intrinsic value, the gain is of 15%. But if we keep moving up towards 798 and 868, we tend to gain more percentage. We tend to earn more profit if we wait for all of these 4 intrinsic values. Thank you for watching this video, and if you have any comments or suggestions or any queries, do let me know in the comment section.